And now, please welcome Managing Director of AB Bernstein, Richard Clarke.
Hi, good afternoon. Thanks for coming back. First session after break. For those of you who don't know me, I'm Richard Clarke. I'm the Managing Director at AB Bernstein, covering the hotels and online travel sector. For those that don't know AB Bernstein, it's a sell-side financial research company. So I write research about blue chip travel stocks, so Hilton, Marriott, Airbnb, Booking, Expedia, and the like. And before you all run for the exits, I promise there's some interesting stuff in here. That being said, the first couple of charts are about stock prices. It's been a good year. It's been a good year for travel stocks. It's been a good year for investing into travel. Not for every company out there, but for certainly the big cap stuff out there. I've tried to create a reasonable spectrum of the lodging coverage there. But if you bought Airbnb on the 1st of January, you made 58%. Booking just slightly in second place. And actually, I had to make these slides a few days ago, and the last few days have been extremely strong yet again. So we'd be back above 60%. And it's been very broad-based. It's not just been sentiment or anything like that. It really has been driven by the fact that these companies are making a lot more money now than we thought we were going to be making at the beginning of the year. So if you look at the EBITDA estimates, the earnings estimates of these companies for where they stand now versus the 1st of January, in general, they have moved up during the year. So travel has recovered more. It's been stronger than the market expected it to be. And on top of that, I think probably largely caused by a slightly more benign rate environment. People are paying more for some of these companies as well. Now, we are always trying to desperately sunset versus 2019 comparisons. I don't know when we'll actually be able to do it, but we've only got one in here. So this is revenue versus 2019, and I think this year will be the year. I mean, Booking were up here earlier and said they'd fully recovered in 2022, but I promise you a lot of companies were not fully recovered in 2022. But this year, we've got pretty much every company that I cover will be posting revenue above 2019 levels, led by Airbnb, which has doubled its 2019 revenues over the last 4 years. So, we are back near enough to normalized territory. Now, that's the backwards-looking position. I'm taking 2023 as slightly backwards-looking at this point. What about forwards-looking? There's a lot of concern out there about the economy, the macroeconomy. I've just picked up here what consensus is, not my own bias this is, but what the market thinks these companies are going to make in terms of revenue growth for the next 2 years for all of the US-listed consumer discretionary stocks in the S&P 500. And travel's really on the left-hand side. Airbnb is going to continue to be the fastest-growing large-cap consumer stock out there. Booking is going to be number 4. Actually, if you stripped AWS out of Amazon, it would drop the other side of Booking, and Booking would be number 3. Expedia, Royal Caribbean, Marriott, Hilton, all these companies are going to still be able to publish very strong growth over the next couple of years. So travel's really still going to be at the top end of the consumer sector. Now, that's the what. What about the why? How are these companies able to do it? And I'm going to talk about 3 factors here, really. It remains a highly fragmented industry. There's lots of market share to play for out there. There are and continue to be very strong demand drivers out there. And then there's a lot of help out there. We've heard it from Sebastian Bazin earlier about the limited supply. That's really going to help the dynamics of these players. So you can kind of just focus this on, there's a lot of numbers on here, but really there's only one number to think about, which is 10%. About 10% of global hotel rooms are under what I would consider the big global brand companies. So that's Hilton, Marriott, Hyatt, IHG, and Accor. About 10% of room nights are sold by Expedia and Booking. You can't add those together because obviously they sell some rooms for the other players as well. And if I went on a couple of slides, I'd say about 10% of the global lodging market is vacation rentals. This is a big exercise we spent a lot of this year doing, which was really trying to get on top of how big actually is the lodging market. We spent months doing it, pulling up lots of local data sources, and really concluded this is a huge market, and it's still very, very fragmented, even for players you think are very big. The OTAs continue to gain market share. I think there has been a difference between Booking and Expedia. If you can't read the labels on here, the blue line at the top is Booking, the yellow line is Expedia. So it hasn't been absolutely everybody's a winner, but most of the players certainly have been market share gainers. Similarly, if you look at vacation rentals, that has continued to gain share of the lodging market. And all of the platforms really have gained there. So they've had the twin drivers of a product that's gaining share and platforms within vacation rentals gaining share. And we expect these to continue. There are some forecasts within those models. And we think that all of those companies, the hotel groups, the OTAs, Airbnb, can continue to gain share. There's still plenty to go after. Now, what about the demand drivers? We think we're kind of back to normal. You know, I get questions on both sides. You know, we get questions from investors that don't spend day in, day out looking at this. You know, is travel over-earning, or has it been permanently scarred by the pandemic? Will we never get back to where we were before? And the questions have sort of alternated over the last couple of years as to whether we're, you know, going to end up below, or whether we're going to go overshoot and come back the other way. I'm going to take the view that we're pretty much normal. It's a pretty boring answer. Now, I think if anyone showed me this chart on the left-hand side is real GDP, so ex-inflation versus lodging room nights, if you can't read the label. By the way, if anyone wants any of these slides, please let me know. Happy to share them with you afterwards so you can see what's on them. But that's real GDP versus lodging room nights. It's a fantastic correlation. And if anyone showed me that, I'd probably think that they'd made it up. But actually, it really does show that travel is, you know, it does move with the global economy over the longer period of time. The one period, I mean, 2009 is missing from that chart. That's post-2009. It would have dipped slightly below then. It dipped down massively during COVID, as we all know. But actually, if I look at where I think 2023 is going to be, which is the point on the top right-hand chart, the side of that chart, we think we're pretty much back to normal. Now, what about going forward? The good news is that although we're all worried about recession, on a global basis, GDP is certainly expected to grow again into 2019, into 2024, and into 2025. Very, very few economists are predicting any territory is going to post negative GDP growth. And lodging tends to grow about a percentage point faster than GDP. So that bodes well. We should have another year where lodging demand growth is growing somewhere in the sort of low to mid-single digits. There is not, what we believe, any correction to come the other side. Now, demand, I don't think, if we look across the entire global lodging industry, demand has not been hugely impacted by COVID over the longer term. Within that, for certain, there are changes. You know, there'll be changes towards more blended travel, you know, maybe less specific business travel. There'll be some changes within that, but actually add it all together, and we're pretty much back to normal. Interesting, the structural change, everyone thought that the structural change might be on demand. It hasn't been. I think the structural change the other side of COVID has been much more on supply. And there's just a couple of charts here. This is the number of hotel rooms in the pipeline. There's been a little bit of a correction very recently, but really pretty steadily during the COVID, the number of hotel rooms that were being constructed, that are being signed, that were going to be built, has come down. Now, that is a chart that tends to move and up and to the right over time. Tends to be that as the world grows, more hotels are going to get built, and so it's really declined pretty steadily for the first time. Now, is that just the COVID impact? Is that just because the uncertainty of COVID meant people weren't signing hotels? We think there's something a little bit more long-term in there. And what I've just shown here is for a selection of Marriott brands. We do a lot of analysis looking at what owners make out of owning hotel brands. This is based on what an owner of these hotels, not what Marriott makes, but what the owner would make of building one of these hotels from scratch. And you can see for all of them, the return on investment you'd make today for building a new Residence Inn or a Moxie or a TownePlace Suites is about 3% lower than it was in 2019. So a lot less are going to get built. A lot less hotels, we think, are going to be built, particularly in an era where the debt rate, the risk-free rate is higher. The ability to open a hotel that will make a positive real return, a return above the risk-free rate, has been diminished. So we think this is a structural change to supply. It's not just a short-term window where less hotels are being built. It's going to continue. Now, what's the impact of this? And this is a mechanical exercise. I appreciate I've got Middle East and Africa as quite a low bar here. I'll explain that in a second. But this is then just looking at, if I look at the regions and I look at what GDP growth would imply that demand is going to look like over the next few years, and I take sort of economists' consensus GDP forecasts, and I run out what that is going to mean for hotel demand based on historical trends, and I look at supply, pretty much in every region of the world, we are expecting demand to grow faster than supply. It's something that Sebastian Bazin was talking about earlier on stage. I think our numbers are a little bit closer than his. He said something like 5 to 7% demand growth and 1 to 2% supply growth. We don't get to that. I think we're a little bit more on the supply and a little bit less on the demand, but basically the direction of travel we agree with. And that will mean, if you look at the right-hand side, that we do expect that these various regions should be able to deliver very good RevPAR growth. When there's limited supply and lots of demand, it's going to publish a very high RevPAR growth. Now, Middle East looks like a bit of an exception here, just to explain, because we're in the region. One, that is the region which has the worst correlation. If I showed you that scatter chart from a couple of slides ago just for the Middle East, it would not look very good for the Middle East. And that's because it's an international region, as you all know. And so it does not tied to the GDP of the Middle East. It's really tied to how much demand can they funnel in from the global market. And so this would not be my prediction. This is just a mechanical exercise of how demand and supply based on local GDP, and it doesn't work so well for the Middle East. Now, one winner from this, if we are going to have, if we are going to have demand growing ahead of supply, does that mean people won't have beds to sleep in? People will be going on holiday and just sleeping on the airport floor? No. Since about 2015-16, that phenomenon has existed, that we've had demand growing ahead of supply, and I think the big winners of that has been the vacation rental product, and will continue to be the case. That the volume winner, this will be good for hotel pricing, this excess demand over supply, but the volume winner, the excess gainer from this will be the Airbnb type product, the vacation rental product, and we expect that will continue to gain market share. Clearly, vacation rentals overshot a little bit during COVID. They've come back a little bit over the last few years as that type of travel really sort of moved forward. But we think we return to this trajectory where we've seen of the market moving towards that. And it's not that consumers necessarily have to swap a hotel room for a Airbnb. It's more the incremental consumer, the next generation of consumer will choose the Airbnb product over the hotel, just because that's simply what's available at the right price point. Now, just a couple of extra little things we've done recently we find quite interesting that I think maybe fit into some of the narrative here. We did a big exercise which was to look at, we scraped the Google hotel review scores for pretty much every hotel. We did 230,000 hotels. That's most major hotels out there. And you can see here what the average hotel companies get. Choice and Wyndham in talks to merge at the moment. Maybe some sign of why they're looking to do that. And the good news for Accor when it came here, they don't do very well on overall average review score, but if you then chain scale adjust this, consumers give luxury hotels much better reviews than they do economy hotels. If you chain scale adjust it, the two best companies in the world that we see are Whitbread and Accor, so two European companies, which have presence here in the Middle East as well. Their hotels are the best reviewed compared to the average. And this was just an entirely academic point, but there is one hotel in the entire world which scores an average review score of 5.0 and has more than a handful of reviews, and that's the Raffles in Bali, the only hotel in the world. I think it was more than 30 rooms and more than 30 reviews, so there are some tiny hotels that do this, but there really is just one hotel which gets a perfect score. So you get a lot of lists of the best hotels in the world. We take an entirely analytical approach, and based on that, it's the Raffles Bali. I've not stayed in there. I'm sure it's absolutely spectacular, but it looks good from that picture. And then one interesting thing that came out of this, and I think we've heard a lot of people talk today about sustainability of travel and sustainable travel, and it seems to go hand in hand with luxury, and it's expensive to do sustainable travel. Just another sign to that. One is consumers do like luxury. They rate it higher. They enjoy their luxury hotels more. But also there is a sort of sustainability of luxury. So the top chart here is mid-scale hotels comparing the age of the hotel versus the review score. And it falls off, or it's the year built versus the review score. And that is true for pretty much every type of hotel. The older it is, the worse review scores it gets on average. And therefore, that industry needs to regenerate. It needs new hotels. Any hotel built in the 70s or 80s is, on average, there will be exceptions, is getting bad review scores. That doesn't happen in luxury. Luxury hotels built in the 1930s and 40s, let alone the 60s, 70s, 80s, are still getting the same review scores as the one that were built today. So we talk about sustainability, and I think there is an element of why would you pursue luxury as a sustainable strategy, and I've not heard anyone say this today. I would do it because those hotels are still going to be there in 100 years' time, not because you just want that type of consumer, but actually there is an element of you build that heritage and it stays. You build a cheaper hotel and it will fall away. And then last, a couple of final slides. One was on India. We did a whole black book on India, if anyone wants to see that, but we've written a huge amount of information about India. And I think it will be the next big travel market. I think that's undoubtedly true. We had someone set up here earlier and say that it's still only a tenth the size of China. That is also true. The top two domestic markets, China and the US, are miles ahead of anywhere else. And India's got a long way to catch up on that. But it will become the third largest domestic market, probably by 2027. And it's really moving up the outbound travel market as well. So we see a lot of opportunity to go after the Indian travel market. It is the one market that's really moving positively forward. And then last but not least, I think just reasons to be cheerful. I mean, I think we set out a reasonably optimistic view, but there's quite a lot to look forward to in terms of travel in 2024. I mean, people have mentioned the Olympics. Taylor Swift's coming to Europe. That's going to drive. That's driven a lot of US RevPAR. There's the eclipse. Don't hear many people talking about the eclipse, but if you look online, everyone's talking in the US about driving to go and visit to see the eclipse. 50% of the world's population are voting next year. A lot of people travel to vote because they want to vote in person. So that will drive travel. There's some new hotels. I put the one was mentioned earlier actually there, the Ritz-Carlton Reserve. I'm excited about that. I'm more excited about Studio Res. Studio Res is a new Marriott brand. You can build it for $8 million. That's the cheapest branded hotel you can build. You can run it with 3 full-time employees. That's going to take over the mid-scale world, I think. So look out for Studio Res when the first one opens. And then I think we're not going to lose recession as a theme. We never have done. I write a preview every year. I've mentioned recession in it every year. The only year I didn't mention recession was COVID, the COVID years. But we will be talking more about sustainable travel, more about artificial intelligence. And I think this theme of supply-demand imbalance will come more to the fore. That's my time up. If you had any questions, please come and find me afterwards. Very happy to answer them in person. But thanks for your time today. Thanks.